This program is brought to you by the Kentucky Small Business Development Center in Louisville. We provide the professional expertise, tools, and resources to help you succeed. To connect with a business coach, call 502-625-0123 or email sbdcinfo@uky.edu.
Hello, everyone. Welcome to another edition of Toolkit Tuesday here with the Louisville Small Business Development Center. I am excited to have you all with us today. We've got a really great presentation and about funding for your business, and I'm just going to hop in and get started. So a couple housekeeping notes. Two things here. So we've got a chat function on the webinar today. So as you have questions throughout the presentation, please drop those in there. I will check that at the end of the presentation and can go over any questions that you all have along the way. And then the other piece is we will send out a survey after the presentation is over, and as well as a recording of the presentation itself. And I will also be sending out my slide deck for this presentation, so you will be able to reference those notes later on. So yes, I will kind of jump in here. So my name is Anne Shadle, and I am a business coach with the Louisville Small Business Development Center. So this is my contact info here, and I'll also have it at the end of the presentation. So a note about what we do at the center is we do group trainings like this, and we also do a lot of one-on-one coaching. So this particular subject that we're discussing today is really something that the coaches in our center, and there are several of us, spend a good amount of time working on with our clients. So please don't hesitate to reach out if this is something that you are working on in your own business, either at the beginning of the business, getting things started, or in some sort of expansion process and need some money to kind of bring things to life. So our goal today is to go through the steps for implementing a funding strategy. And yes, we are shaking the money tree. So we have, I have sort of a fun extended metaphor of different types of trees and what they represent throughout this presentation. So it's kind of goofy, but I think it's also cute, and trees are great. So yeah, so we're just going with it today. Maybe it'll help some elements of this stick. So here we are. So this is kind of our plan for today, is to go through these 5 particular steps. So the first piece will be understanding the sources of funding. The second piece is to determine the amount of funding that's needed. The third step is to identify the different sources of funding that are available for your business. The fourth is a quick overview on writing a business plan. And the fifth is just kind of the final piece of actually going and approaching the funding sources. So the bulk of our time today is going to be spent in steps 2 and 3, because there's a fair amount to do with that. So the understanding the sources, the options for funding here. So at the beginning of starting a business, it often can be a pretty nebulous process, because you're not exactly sure what you need money for. You know that you do need money. You might not know exactly how much you need. There's often more costs kind of hidden in the process of starting a business, that until you get into it, it can be hard to anticipate some of those things. So again, this is really where I do think the coaches at the Small Business Development Center can be really helpful, is kind of making sure that you're being thorough in that initial assessment of how much you need and what you need it for. So yes, so the 2 kind of primary options for securing funding for a business is going to be debt funding, and then the other side is equity funding. So on the debt side, this is just a little bit more information kind of differentiating these 2 basic pieces. I have conversations with clients who are like, I have had people approach me saying that they're interested in investing in my business, and I have no idea what that would mean, what they would expect, the investors, what I should expect as the business owner. And so this is kind of one of the conversations that I'll have with folks at the beginning, is what is equity investment versus debt service. So in the debt space, this would be coming from a bank loan or another lender. There are different kinds of lenders besides just banks, and we'll talk about those a little bit further down. In the debt space, this allows you to maintain ownership and control in a way that you may not necessarily with an equity investor. In the debt space, you would be repaying that initial amount of money that you borrowed with interest. And then, kind of the analysis of this is that it's considered by some to be the cheapest way to grow, in the sense that this bank does not own your company. They don't get a share of your profits. They just get that money that they gave to you plus the interest that is, compounded over time. Something that anybody can download this. There are loan calculators that you can look up, but we can help, sort of figure out what would those loan payments be depending on what the terms are and the interest rate, and then what is the total amount of interest that you're paying back in addition to the principal, so you can really kind of see like how expensive is it going to be to get that money. So that's the debt side, and then the other side is equity, and so this involves an investor. It can be an individual person, a private situation, or there are more formal structures and companies that do investment. So that investor will give you money in exchange for some portion of ownership in your company. Generally, you don't pay that money back. However, I've also seen deals where you do pay the money back. This is kind of it can be a space where you're often writing your own rules between you and this particular investor if it's a private investor. So this then means that you have shareholders in the business, and there is the potential to have huge benefits beyond that actual money that's invested. And I think of this again. There's different options for some benefits with the investors, but if that person has access to contacts, whether it's like suppliers that are hard to get connected to, or obviously clients and customers, if that person can connect you to those, then it can be really beneficial in helping you get your name out there and helping connect you to people who can be really valuable to the business success. So just kind of important to know, like, what are your options? Not that one is good or bad or right or wrong, just to sort of know the full landscape. So step 2 is going to be to determine the amount of funding that is needed. And yeah, so this is what I say, that this can be kind of there can be a few steps involved in this. So as you're sort of thinking through, how much money do you need, you first want to think, how much money do you already have to put into the business? So that is what would be called owner injection. And then what are, kind of any places that you could get cash. So this could be, like I said, from yourself, from an investor, collection of accounts receivable. This would be for an existing business who had money who had already sold products to the customers and then was waiting for those purchases, waiting for the cash to be repaid. So if you were to collect all that money that was owed to you, you could take that as cash to invest in something else for the existing business. You could sell inventory, and then obviously loan proceeds as well. So these are, kind of different options for where you can get the money from, and then what you're using it for. So, and this is a very short list of what is, there's lots of options for what you would need the money for. And again, I'm sort of lumping all this together as far as a startup business versus an existing business. But you could be using the money for purchasing new inventory, purchasing a starting inventory. You could be making payments with it. You could be purchasing equipment, making office expenses. You may have to put, if you're a startup business, you may have to put down a deposit on an insurance premium. You may have to put a deposit on rent for the space. You may have to put a down payment on a building if you're purchasing a building. So lots of labor costs, for training folks before you start the business, lots of different ways that you would need to use that cash. So this here is kind of a little like example of a particular company. And we've got some tools at the Small Business Development Center where we help folks to kind of make these lists and work through these different lists of essentially startup costs that you would need the funding for. So on the left side here, we've got sources of cash. And so in this particular situation, what we're saying is that this business owner needs $100,000 in total to get the business started, is what the assumption is here. And so we're saying that the owner has $20,000 of his own cash that he or she can put towards the business start. And then we've got some blank lines here for where this person would then go to seek the rest of this $80,000. On the right side, we've got a list of exactly what that person would be using that money for to get the business going. So equipment and machinery, furniture and fixtures, initial inventory, and then 6 months of expenses, just to give you some time to have. So those expenses would be all of your fixed operating expenses like rent, utilities, other insurance premiums, telephone, internet, trash service, etc. Just having some extra cash to pay those expenses while the business is getting started and generating its own income. So the question here is, okay, we've identified we need $100,000. I only have 20. Where am I going to go to get the remaining $80,000? So then here we kind of get to the guts of all of this, is like, what are those options for this particular person? So this is kind of a long list of all these different ways. And in here, we're kind of mixing in that debt and equity into this list as far as options for funding. Because, when you're looking for money, you want to be exhaustive in saying, like, let's look at any and all options to get funding. So, I mean, and again, kind of back to like reinforcing what we do with the SBDC, is that we do this sort of analysis. It's like, what option do you have here? What option do you have there? Really kind of asking you a bunch of questions to help you think through these different pieces to see, what options you have, to make sure we're not leaving anything on the table. So personal funds would just be, your own money that you had personally saved. Then bootstrapping, and I'm going to go into this a little bit more, but this is sort of like a slow growth process, like maybe not bringing everything like into life in its fullest form immediately. It's like kind of doing like, I'm just going to see what is my minimum viable product. I'm going to start with online sales where I don't have to pay for rent. I'm going to grow that a little bit, and then I'll add some pop-up spaces, and then from there, from pop-up spaces, I'll do maybe a temporary location in Logan Street Market, and then maybe from there I'll get a bricks and mortar shop. So doing sort of various steps where you can just kind of self-fund along the way, where you don't need so much money in the beginning. Then direct business loans, it would be doing something from a traditional bank. Local loan programs, there's a fair amount of community developed CDFIs, community developed financing institutions around town that are other options. There are some credit unions that offer some micro loans. There are loans through the city of Louisville that are meant to be for helping small businesses. So, and again, we have a pretty good handle on what are those different options. Then the next option here is a line of credit. So lines of credit come when you have equity in generally a property that you already own. So this could be in your own house, if you own some other kind of property where you paid $100,000 for the building, it's now worth $200,000, and you only owe $75,000 left. So you would have $125,000 worth of equity in that piece of property that you already own, and you could take that money out and use it to get some funding. Sba Guaranteed Loans is a whole other sort of category of a type of kind of traditional bank loan. I'll talk about those more later. Crowdfunding, we'll go into that in detail, what that is, and then angel investors, kind of back to the investor space. So I would say this is a really good slide to hang on to, a good list to hang on to, because you want to go through every single one of those and see if that is an option for you to get funding for your business through any and all of these different choices. So, okay, so now what we're going to do is kind of do a deeper dive into each of those different options. So personal funds, this becomes your own equity into the business. It shows up on your balance sheet and essentially adds to the value of the business. So something that I will say to folks when I catch them in this sort of startup space is to say, very early on, my suggestion is to open a separate bank account. Even if you haven't registered the business, open a separate personal bank account. Take that money of your own that you are thinking to use, for some of these startup costs, put it in there so you can make sure that you have a really easy way of tracking all of the money that you yourself personally have put into the business. Because again, that lives kind of in eternity on the balance sheet as money that the business owner has put into it, and it will increase the value of the business. So you want to make sure that you're capturing those numbers. So here is kind of a long list of places for you to think about where you could get some personal funds from. So whether that's your own cash and savings account, whether you have equity in your own home and take that out in a line of credit like we just talked about. Friends and family is definitely an option. Whether you've got folks that have known that you wanted to open this business, and they want to help give you some money, and maybe you pay it back, or maybe you don't. Certainly something to kind of have transparency and intentionality with how those conversations go, because when you mix money and family and money and friends, it can go wrong. So I always say that don't do it quickly, do it, like make sure that you talk about the what if of, what if you can't pay it back? What does that look like? Credit cards, not necessarily the best option, but certainly an option that lots of people access. If you've got credit cards in your name, taking money out of that can be a way to do it. If you have equities or some kind of stock portfolio, if you wanted to take money out of the stock market and use that to invest. Retirement accounts, there's, depending how old you are, there sometimes is like a 10% penalty if you take money out of your retirement account early. But maybe that's worth it to do that, and then bootstrapping techniques is kind of some of the things I was talking about before. So just all sorts of options to think for you to get some of your own money to put into the loan package, essentially. Something that I think is important to note is that if we're going to a bank or any lending institution, traditional or non-traditional, and asking for money from them, that lender is going to ask you, what have you as the business owner put into the business? They want to see that you have some skin in the game. So be sure to know that it's not that you can start a business and put $0 in it and expect to borrow $100,000. You're going to have to put some money into it. So be prepared for that. So diving into bootstrapping a little bit more. So bootstrapping is finding ways to avoid the need for external financing or funding through creativity, ingenuity, thriftiness, cost cutting, or any other means necessary. So here we jump into our tree analogies. I don't know how I missed one for the personal funds, but elm trees represent intuition and inner strength. So, this is really sort of thinking like, how can you be kind of like creative and sort of sneaky or tricky a little bit, and and be a hustler, right? Like see how you can cut some corners. And so here's some really good, I think, examples to kind of hold on to of types of bootstrapping methods. So buying used instead of new equipment. As you do that, know what questions to ask about the used equipment to make sure that you're not getting something that's in really bad shape or it's going to break soon. Ask questions about warranties, understand which brands have a longer life expectation, right? So you kind of have to have some knowledge, some industry knowledge to be able to do that one. The second one here, obtaining payments in advance from customers, I think is a good idea. So if you've got some kind of product that you can do like a pre-sale for, or set up a subscription service that that folks will sign up for, you can get some cash in before you have to put out the product, and that can help to cash flow. Vendor financing. So this is if you're purchasing equipment and you see if you can get financing from that equipment manufacturer itself. It can be a little bit easier to do that than going to a traditional bank. If you're just like, I need this one piece of equipment and I'm going to see if they'll offer me financing for it. You want to ask lots of questions about interest rates and terms there to make sure that you're not getting into a bad deal. Coordinating purchases with other businesses. So, this is like if you're purchasing some wholesale items and they come in a bulk quantity and you only need, say 30% of that quantity, is there somebody else that also could need those same items that you could potentially kind of go in together and coordinate and say, you go 70, I'll go 30, so that you can maybe get that discount, get that access to that better pricing, but not have to pay for all of it up front. Leasing equipment instead of buying. This is, again, something that it's obviously better to purchase it if you have the option to, but if you don't, you can lease it. There's also lease to own equipment situations in this, where you're making payments for 5 years on an ice machine and then now you own it yourself. That certainly makes a ton of sense at the beginning. And then sharing office space with other businesses, kind of decreasing some of your fixed costs. So, this is just kind of a bunch of examples, but really the idea of like, kind of growing slowly and like making a little bit of money and then taking that little bit of money and reinvesting in the business to get that next piece of equipment. Sort of thinking of it like that. So that's personal financing and then bootstrapping. And so now getting into the traditional loan space with kind of like any regular old bank out there. So this slide has the kind of framework for what any bank or lending institution is going to be analyzing when you come to them saying, I need money for my new business or my existing business. So the 5 C's of credit is kind of what we call this. And so they're going to be analyzing your character. So what is your track record with debt and with work experience? If you're going into, if you want to start a business in an industry that you don't have any experience in, they're not going to look quite as good on that. They're going to want to know, do you have close advisors? Do you have people who are going to work with you already that have experience in that field? They want to make sure that you are very knowledgeable and as close to expertise in that particular industry as possible. The second piece is having collateral and hard assets to secure the loan. This is the piece that I see kind of prohibiting people from accessing credit so often, because if you're purchasing a building, that building then acts as collateral. And to back up a step here, collateral is, so say you need to borrow $100,000. In addition to promising to repay that $100,000, they want you to have some physical thing that you own that is of equivalent value that the bank can take and turn around and sell if you're unable to pay the loan back. So if you're purchasing property, that's pretty easy because there's the collateral is kind of baked into that naturally. If you're purchasing equipment, depending what equipment it is, the bigger equipment that can also potentially act as collateral, where that's something that the bank could take and then turn around and sell. When you're purchasing, when you need money for just like working capital, so for initial inventory purchases, for small wares and supplies, for labor costs, before the business starts to make money, for rent deposits, all of those things are things that the bank cannot take, right? Even if you're doing renovations, the bank can't take your drywall and your paint and turn around and sell that and make any money. So this is where you have to have something else that can act as collateral in order to get access to that money. So often folks will end up, saying, how much equity do you have in your own house? And then they use that to secure the loan. It's certainly risky, right? Like it means that if your business doesn't work, your house and your whole personal situation is now potentially affected. So it's not something I say to go into lightly, but it often ends up being the piece of things that is kind of necessary to make the whole deal work. And know that in this space of collateral, and we'll get to this later on, that there are certain loan programs that are these SBA backed loans that can be a bit looser in the collateral space. So I'll talk about that a little bit more. So capacity is the third C of credit here. So this is your ability to repay the loan. So what they're looking at in capacity is, this is where you'll need to turn in financial projections, either for what you think the first 3 years of the business will be, or if you're an existing business, what the sales of the business would be if you were to get this injection of cash, and then you can essentially grow the business. So this is where like we can really be helpful at the SBDC, is that we've got some really great tools for creating these financial projections and kind of can work through it first, the two of us, to say, hey, do we think that this business is actually going to bring in enough extra money, to pay off this loan and then to pay all the other expenses associated with running the business. It's important first for you to know that and feel confident in that, and then to also share that with the lending institution. So the fourth C of credit is conditions. So this is, what are the risks involved? What is the market space that you're in? Is it an already saturated market? Is it a market that's trending downward? So we can kind of help with market research as well. We've got some tools for market research at the SBDC. And then capital is just your commitment, your own cash injection, and your own credit score as well. A lot of people will say, oh, I want to start an LLC so that like my personal stuff is not associated with any of the business's activities. And the reality is that that's just not possible. Like, they're going to pull your personal credit score when you go to ask for a loan at any lending institution. There's no way that you can divorce yourself personally. So this is why, it's a question, there's often a question of timing. Is like, if your credit is not in an awesome place, maybe you need to take 6 months and work on, kind of improving that or doing some things to get that squared away before starting the business and going for a loan for the startup funds, because your own personal situation certainly gets wrapped up into the finances of your small business. That's just a reality. So back to this question of collateral. So it's important to understand that banks discount the value of the collateral to allow for changes in the market and to approximate a quote unquote liquidation value should it become necessary to sell that collateral to pay down or pay off the loan. So this next sheet talks about some of these different, some of the percentage of the total or the original value that the bank will accept. So, and I won't go through every individual thing here, but the big thing to note is that it's not that if you have $100,000 of equity in your home that you can pull that full $100,000 out. I think we have over here personal property, the discount value is 80 to 85%. So know that it won't be the dollar for dollar, like exactly the amount that you have in that equipment or in that house that ends up being able to be used for collateral to secure something else. So I'll kind of leave this up for a second. Just other, there's other options with with different choices here. And if anybody has questions, just put those questions in the chat and I'll kind of hit everything up once we get to the end there. So kind of moving on beyond collateral. So other parts that are important, again, in this sort of traditional loan space, things that are necessary to think about is not only the interest rate that you're getting, but then also what is the term of the loan. And this is the term of the loan. I've got some clients I'm working with right now. It's so important to understand, what is that loan payment if it's on a 10-year term versus on a 20-year term. If you're on a shorter term, you'll pay less interest, right? Because you're paying it back in a shorter amount of time, but it means that your monthly payment's going to be higher. So this is where we can help kind of run some different scenarios and see, and to some degree, the bank won't let you choose what term you want, but you may be able to say, 7 years or 10 years or 15 years or 20 years, 20 or 25 years. And so it's important to look through, and then you can take different numbers for what your monthly payment would be, and then drop that into your financial projections and say, okay, if my payment's $1,500 a month versus $2,500 a month, that's going to make a pretty big difference to me. It either puts me close to breaking even, or it puts me, with a decent amount of cushion. So just something important to think about. And again, that there are some limitations or expectations that the bank will have depending on what the use of funds, so what you're going to be purchasing with the loan. So just some other kind of things, I think these are all really important to note when you're in this space of term loans. Obviously, you're repaying them on a monthly basis, both the principal and the interest. Two different qualifiers on the interest rate. So one is a fixed rate, and that means that the interest rate stays the same for that whole period of time, or a variable rate, which means that the lender can require different payment amounts when the interest rate changes. So in a broad sweep generalization, in a commercial loan, so if you're buying a commercial property or getting a loan for a commercial business, the rate is often fixed for the first 5 years. It can be amortized, so paid off in a 20-year term, so having a longer term, not that you're paying it off in those first 5 years, but that interest rate may only be fixed for those first 5 years. So what happens after those 5 years is you either have to refinance the loan if you're able to, or the interest rate will just then become a variable rate. And so from month to month, it changes based on prime plus 1 or 2, whatever the bank has kind of worked out that's their deal. But so as that prime interest rate changes, which it is right now, right? Everyone's talking about how interest rates have already gone up a little bit and are expected to go up several times throughout these coming 12 months. That's going to affect your payment, right? Because the interest rate changes. So it means that you won't have the same payment every month if you have a variable interest rate. Then this last portion here, and I think this is a helpful piece to know, is that the borrower can request, if eligible, if this is possible, given the lending institution, that the lender set up the loan so that for the startup period, or potentially for like some kind of construction period of time, you only have to pay interest payments, so not the principal. You just would be making interest payments, and this allows the business to start to generate some income before you have to start making those full loan payments. I see this most consistently in a sort of a construction loan, where we say, okay, we're going to give this a 6 month construction period to build all of this. And so during those 6 months, you just have to make the interest payments. And then after 6 months is up, then you have to start making the principal plus interest payments in full. So just kind of details and little tips and tricks to keep in mind. So in this space of these kind of direct business loans, they're most often available or more easily accessible to established businesses with a track record. So in the space of a startup business, it's often pretty difficult to get a kind of traditional bank loan because there just are very often fewer assets. If you're going to rent a space and you have to do some renovations to it and you have to buy your initial inventory, there's no collateral built into any of that. And so it's going to be hard to make it work in a traditional bank space. Doesn't mean you can't do it. That's why there's a sort of, full a la carte menu of options. So the second piece here is that direct business loans are accessible when the business owns assets that can be committed. So whether if the business owns its own building, if it has equipment that can be used as collateral, if the business has a ton of cash in it and you'd be willing to take some of that cash and put it into a CD, and that can kind of act as security. The other piece is that the business owner has maintained good credit, that's important. And then that the business has financial statements and projections that indicate their ability to repay those loans. So if you're an existing business and you're going for a loan, not only are you giving projections for how much the sales would be once you get this money and invest in that growth piece, but you also are going to show historical records of what the business has been doing from a sales perspective, as well as expenses, to see, has the business been bringing enough money to pay its own bills? So here's the thing that's implied and assumed in that statement, is that the business has been keeping financial records. So that's something that oftentimes small businesses will not make the time to do, will overlook, will not even know that it's a good practice to do. And so this is kind of the place to start with this, is if you're an existing business and you want to be expanding, you need to make sure that you've got profit and loss statements and balance sheets, which are two different financial statements. So you have those for the previous 12 months. I mean, you're going to need them for the last 3 years at least. So to make sure that you've got those things in place to be able to turn into the bank to show. I mean, I don't think it's them being unreasonable. It's saying, I want to know if you are making money, if you're paying your own bills. Let me understand what you've been doing so far. So that's pieces with kind of just like traditional going to a regular old bank. This is a list of some, but not all, of the local loan programs that we have in the Louisville area right now. There's lots of, so if you all are watching, because I know people watch from different places, if you're watching from a city that's not Louisville, whether it's Lexington or elsewhere in the country, there often are programs through city government or different community development financing institutions that can be helpful in offering loans or being able to offer financing for businesses that can't access some of those traditional loans. So I won't go too deep into these, although I could. I spent a lot of time talking about one versus the other. Each have different interest rates. They're often, I would say on the whole, the expectation is you would get a little bit higher interest rate and a little bit shorter term to pay it off, meaning that your payments are going to be a little bit higher, but you'll have an easier time accessing this. So most of these institutions are going to need some kind of collateral, maybe a little bit looser on what they'll accept for collateral than a traditional lending institution. And then they'll be a little bit looser on credit requirements. They'll be a little bit looser on how much cash the business owner has to put into the business. Outside of that, you're still going to need to put together a business plan. You're still going to need to put together financial projections. They still want to understand the capacity and the experience, those character and capacity pieces of the 5 C's of credit. They're still going to want to know that. So it's like some pieces are a little bit looser. So, I mean, really, it depends. Kind of the first place I start with my conversations with folks is how much do you need? because there's different limitations. You know, the micro loan with Park Community Federal Credit Union goes up to $10,000. They've got some other programs over there now that are newer that can go up a little bit more. L Home has had some loans that go up to about $15,000. Community Ventures has some that go up to about $50,000. Metco has some that go up to $50,000. You know, so it just really kind of depends like how much you need, where it makes sense to go and talk to folks. So shifting from, we've gone through now personal financing, bootstrapping, traditional loans, local loan programs, and now lines of credit. So I talked a little bit about this at the beginning, but essentially the idea with a line of credit is that it's an agreement between a bank and a company or an individual to provide a certain amount in loans on demand from the borrower. So the thing that's kind of, I think, unique and really great about lines of credit is that the borrower is under no obligation to actually take out a loan at any particular time, but you may take part of the funds at any time over a period of several years. So once a business is established and has some collateral, has some assets, some physical assets in the business, it's often a really good idea to work with your own bank and say, I just want to get a line of credit set up for like however much you think I can have it for. It doesn't mean that you necessarily have something in mind that you want to do with it, but it can be something that you just have it there almost as like another savings account. Because, so let's say you're approved for a line of credit for $50,000, and you don't need any of that money right now. So you just have that money sitting there and you don't have to pay anything to have access to it. So of that $50,000, let's say you have a piece of equipment break and you need to buy a new piece of equipment for $5,000. So you take out $5,000 out of that line of credit. So then what happens is that then the next month after you take out that $5,000, they'll send you a bill for, you only have to pay the interest amount on that $5,000. So, and the interest rate is a variable interest rate. So it may be, let's say it's 5.5% right now. So that month you would only have to pay that 5.5% of the $5,000. So then the next month, let's say interest rates go up. And so then the next month it may be 6.5% if the interest rate has gone up. If you don't, you only have to pay the interest portion. It's a really good idea to also pay some of the principal as well, because if you don't, then there often is like a balloon payment at the end of some period of time with the line of credit. That's if you've only paid interest payments and you've never paid anything back on the principal, now all of a sudden you owe the entire principal the next day. So just something to kind of talk through, like what are those times when different pieces are owed. But it can be, it's really nice because, like, let's say you're a business that has a seasonality in your sales and your expenses still kind of stay consistent throughout the year. So you have times when cash is a lot shorter, but you know that like come next summer when sales pick up again, you'll have enough money to pay this back. So you can borrow money from that line of credit during those slower periods, and then maybe then you're only making interest only payments when it's slower. But then once sales pick up come summer, now you start to pay big chunks of money back to get that balance back to zero. Then once you hit zero and you paid it back, you can take more out. Like when you have up to that $50,000, again, think of it like you have $50,000 in the savings account. You can take out $5,000. If you need another $5,000 the next month, you can do that. If you want to put back $2,500 the third month, you can do that. Now you only owe $7,500. So those monthly payments are calculated each month based on the current interest rate and then how much of the principal that you've drawn down. So so they're helpful, and I do think that they're really nice to have for a quote unquote rainy day. Lots of businesses that I know, once COVID hit, March of 2020, folks who had a line of credit already set up, it was really nice to say, okay, I know that I have another $50,000 that I can get if I need to. They take a little bit to get set up with your bank, and so it's often one of those things that, like, if you need it in a pinch, you can't get it set up fast enough. So I do think it's really good to do when you're not in a crisis. So that's my 2 cents about lines of credit. So they're often used for handling short-term needs. They're renewable each on a yearly basis. So all you have to do is just like sign some papers again, turn in your most recent year of tax returns, fill out a personal financial statement. They do require collateral. So if you had $80,000 worth of assets, physical assets in the business, they wouldn't give you a line of credit for that full 80. It would be some discounted value like we talked about earlier. So maybe it's 65,000 that they would give you a line of credit for. So here the line of credit is the palm tree. It represents peace and flexibility. So that's just wonderful. It really is. All right, so moving on to the SBA loan programs. So SBA loan programs are like a birch tree. They represent new beginnings. It's so fun. In general, so here's what an SBA loan program, what the SBA does in this space is they provide a guarantee for that loan to the lending institution, to the bank or to the CDFI. So what happens is that the lender, oftentimes banks are pretty nervous to lend to new businesses or to small businesses, right? I mean, we've all heard the statistics. It's like 85% of new businesses close in the first 12 months of being open. That's a pretty big risk. That's a more than 50% chance that this is not going to work. So banks are understandably hesitant to give money to a concept that's not been proven. So what the SBA does, because their intention is to support small businesses, is so they provide this additional guarantee so that if the borrower doesn't pay back the loan, the SBA will guarantee the loan. So it just makes it so that the bank is more interested because they know that they've got a kind of backup option to get that money back if the business doesn't work out. Important to note that that doesn't mean that you, as the business owner who defaulted on that loan, doesn't mean that you're out of trouble because the SBA is paying it back. You still would have your own issues, that you'd be responsible for paying that money back. It just means that you can, you'll have an easier chance of getting the loan in the first place. So with the credit piece, with the collateral piece with these SBA loans, it means that they'll also, if you don't have that dollar for dollar collateral baked into what you're going to be using the money for, this can help in that space so that you can have some collateral but not 100% of what you need, and you'd still would be able to access one of these SBA 7A loans. So this is a lot of what we work with our clients, because again, like I said, if you need money for working capital, you need money for renovations, a lot of that stuff can be hard to have collateral to secure that loan. So in general, the loans are for small businesses that are not able to obtain credit elsewhere. So if you do have collateral, they will make you use that. But if you don't, then they'll say, okay, let's go into this SBA loan backed program. It still requires the 5 C's of credit, and it kind of functions in the way that a regular loan would. It's the same application process. In fact, it can often be longer because you have to get approved by both the lender and the SBA. And I'm kind of jumping around here, but the program operates through private sector lenders that participate in these programs. So, all the big banks generally participate in these SBA loan programs. Something that folks may have heard last year is all this conversation about PPP loans. Their PPP loans were administered through this sort of SBA program. So lots of banks who didn't have a relationship with the SBA, smaller banks, started working with the SBA as a way to be able to access these PPP loans for their clients. All right, crowdfunding. So kind of getting through all of the traditional loan space and what that takes, and moving on to crowdfunding. So what is crowdfunding? It is the practice of funding a project or a venture by raising many small amounts of money from a large number of people, typically via the internet. This type of lending features lower interest rates or creative repayment terms. And I've got some more information on the next slide about different, kind of the most common different places for crowdfunding. They're often either equity-based, where those people kind of own a little tiny piece of your company, or rewards-based, where you sort of give them one sample of your product or something in exchange for them giving you the money for the business. So a few things, and I'll just kind of read this because I think it's all really valuable information. Just tips as you're putting together your sort of ask on a crowdfunding platform. So you want to humanize it and frame your case. You want to make it personal, share your achievements and progress, share your background, what are your dreams, what have you already invested in the business, like what stage of things is the business at, what have you already accomplished, and And then, I mean, in general, the idea is that you're telling your story. You want this to be emotional. You want people to connect with you and to believe in your, in your vision for things. So there's these different, platforms, Kickstarter, Indiegogo, Kiva, Gofundme are kind of the big ones that people know of these days. And I've got different information here as far as like, what's the cost to participate. Some of them have a deal where it's like fixed funding, meaning if you say you set a goal that you need to raise $10,000, unless you hit that goal, they won't give you the other money that was promised to you. So Kickstarter is like that. So if you only raise $5,000 of the $10,000 you said was your goal, they won't give you that $5,000. Indiegogo, on the other hand, if you they will give you, like, you can actually choose. You can either have it be fixed funding or you can have it be flexible. You just kind of have to choose that at the outset before you launch the program. Yeah, so that's those two. And then Kiva is a 0% interest loan. So not like a grant, functioning like a grant like Kickstarter and Indiegogo, where you keep the money and don't have to pay it back. Kiva, you do have to pay it back, but and there's a fair amount of nuance to Kiva, depending if it's through like sort of another partner institution or directly through Kiva. Kiva works internationally in like, I think it's like 80 or so different countries. So it just really depends like where you are and then what the structure is, if they're partnering with another institution or if you're going directly through Kiva. And then Gofundme, can be personal, this can be for your business. It's often used if you need money for like, you've had some kind of like tragedy or damage to your house, or you need money for funeral expenses or medical bills. That's often what people think of for GoFundMe, but it also can be used to get a business going as well. So just some kind of notes about those. And in the crowdfunding space, I think one of the kind of hidden values to crowdfunding is that in addition to raising money to help the business get started or to grow, you're also doing marketing, right? Because you're learning to tell your story, you're learning to connect with your clients, you're learning to, like, you're getting people to follow you, you're gaining traction in the marketplace where they want to watch and see how the business gets going. They want to they want to follow along in your progress. And so particularly if you're going to open a store, they're you're ready to open the doors. I want to come in and be there for the first day because I helped, to invest money. So it serves a dual purpose in gaining traction and gaining, kind of a market of folks who are interested in the business, as well as securing funds to get everything going. So it's a really nice thing. There's a lot of noise in the marketplace, so you have to know that, like, you're not going to be the only person out there trying to open, a coffee shop or trying to open a t-shirt store. You need to really hone in on what is your pitch and what is your differentiating factor, and kind of, again, in the space of like, tell your story, make it emotional, like make them fall in love with you, and and feel what you're feeling. Like, they'll, when they feel something, then they get out their credit cards. So keep that in mind. So here's just a couple articles, and again, we're sending all these slides out, so you'll kind of get all this stuff. And then for folks who kind of have a lot of questions and are engaged in this all, like, my contact information will be at the end, so you can reach out and book a one-on-one, and I can go through all of this stuff with you and kind of apply it to your own particular situation. So so know that I won't leave anybody hanging if you want to have more conversation. I got 9 minutes. All right, so our last piece here is in the equity space, and we kind of talked about investors before. So they kind of represent the ash tree, which stands for growth and strength and a higher perspective. So an investor can kind of look from the outside and help make these connections and sort of see how you fit into the whole market space. So angel investors in general are individuals who invest their own personal capital directly into startup businesses. The prototype is somebody who's about 50, income and wealth, well-educated, succeeded as an entrepreneur, interested in the startup process. There's lots more angel investors that have kind of come up in the US over the last decade or so. And they're valuable because of their willingness to make smaller investments and then their connection to industry knowledge and other good connections within the marketplace. So in the space when you're looking to make a pitch to investors, usually you're thinking of like a pitch deck versus a business plan, although the information is generally the same. But different things that an investor is going to be asking about is this a scalable product or service? So is it something that can grow pretty fast? Burn rate is like how fast are you going to be using the money from them before you start to generate your own income? Often, I should sort of step back and say this, in the investor space, it's usually for these like tech companies that have high growth in a short period of time, because investors are expecting to get a pretty good return on their investment in a short period of time, maybe 20% over 5 years. That's kind of like a general standard. So know that like often retail businesses or restaurants, like there just isn't that much extra money embedded into the business plan. So it's hard to attract investors. You'll need to have like an evaluation of the potential for the business to make money, and some of these other pieces in place if you're going to be connecting with like traditional investors. So just some other websites and information on there is helpful. So a very short note on writing a business plan, because we actually just did a presentation last week. If you look on our YouTube channel, one of the coaches in our center did a great presentation on business planning. So I'm not going to go too much into here, but the idea is that if you're a new business, you need to learn the industry you plan to operate within. And if you're an existing business, you need to deeply understand the business opportunity or growth expansion option here that you want to pursue. So here's some good links for different places to do research. The Louisville Public Library, lfpl.org, has a ton of really great information on there. So kind of get lost on that website. I would highly suggest that. So the idea with writing a business plan is that you want to identify the challenges and solutions within your own marketplace, that it helps to convey to others the intended path of the business. And it doesn't have to be super long. There's, like we shared about in the other presentation, there's some pretty short, concise, 1-page, 2-page options for business plans, and then there are much longer ones. But the basic tenets of it is that you're going to have an executive summary, a description of the business, a marketing plan, management plan, who are you, and then financial plan. So all those projections for the coming several years of business and sales and expenses. So the last step in this whole process is to then go and approach the sources. So the things that you want to have top of mind and already prepared and curated answers for is, who is the management team? What are your skills and past performance that are important? What is going to make you succeed? Whether you're going to talk to your parents about putting money into this business or you're going to talk to a traditional banker, you need to have that information, readily accessible. Have a thought out plan for how you're going to bring this business to the market. What is your long-term vision and what are your future plans? What are your options for growth? And then if you get told no, try and figure out why you were told no. I've heard, I've talked to folks who have tried to do some work in the traditional investor space, and hundreds of people say no, but all you need is one person to say yes. So learn as you go along the way. If you get turned down at one bank, if you get turned down from one investor, understand that and incorporate that in so that your pitch gets stronger as you go along. This is a teeny little slide on just different questions that the venture capital or some of these investors would be wanting to look into. I'm not going to go into all of that right now, but just know that that's there. And then, kind of final points here is, use the funding that's appropriate for your business. Like I said at the beginning, the bank or anybody's going to want to know that you have some of your own money and invest in the project, so that you're going to take it really seriously and give it your 110%. So make sure that you're willing to commit your own funds, and then write a business plan to help you plan for, kind of the whole future of the business, so that you can shake that money tree. And here we go, my info again. That calendar link there allows you to book a spot right on my calendar. So I think I've got some, a couple weeks out from now. So, or feel free to shoot me an email. And like I said, we will send all of these slides out. And then there'll be a recording as well. So you can go back if there's pieces that you missed. I speak quickly sometimes, so I apologize. So I'm looking through the questions here. Any other any other questions that anybody has, feel free to drop them into the chat. And I will, I don't know if you guys can see that piece. Yeah, I'll answer them to the best that I can. Lots of folks are asking about the recording and then the slides. So yeah, so know that will be passed around. Yeah, I mean, again, I think really this is a space that we can be super helpful at the SBDC because we have a pretty good understanding of a lot of these different lending institutions, from traditional banks, from some of these community partners, from crowdfunding, from some of these kind of non-traditional sources, and we can help you talk through and make sure that you're not missing anything in the different options that you could go to for funding, and then putting together like what is this whole package, making sure that you're not missing any documents, something that I don't think we had on here, but just the typical things that any bank is going to ask for, or more kind of informal lending institution. They want your last 3 years of tax returns. They want what's called a personal financial statement. So this is where you'll be, putting information together as far as like, what do you owe, what do you own, and what do you owe? So all of your assets and liabilities personally. So kind of collecting some of that information is really important. So yeah, I'm seeing more questions on here about, just like we'll have everybody's information, and we'll definitely reach out to you with all this stuff. And then our website is LouisvilleSmallBusiness.com. And then there's a page on there called Coach Connect. It's one of the top tabs. And then you could also like book right on my calendar or any of the other coaches, Dave or Rhonda, their calendars are listed there as well. And specific banks, if somebody's asking about any particular banks that could help with that, that's with the startup loan. I mean, this is where we kind of have to have this sort of like overall conversation and analysis of, like, again, of kind of how much you need, what you need it for, what options do you have for collateral. So it ends up not being like a simple question. It's like, just go to this bank. Kind of need to have that broader understanding of, of your whole financial situation, that what kind of business it is. And from there, I can kind of help and direct you towards, based on how much money you need, and what you'll need it for. We can kind of talk through what will make the most sense for which lending institution to go to. So it can be challenging, again, because like I said, often, it's a pretty big risk for banks. So to work with a startup business. So this is where like having some of these other options through the city of Louisville, because they've got something called the MIDI loan that is meant for startup businesses and for working capital. I mean, they're going to ask you a ton of questions. They want to know that you know what you're doing. They want to know your background. They want to know, they'll dive into the financial projections and ask about, this cost looks pretty high. Did you forget to put in cost per X? They like, it's their job to really make sure that you know your stuff. But that's, some of those places are easier to get through for a startup business. So yeah, I think we're right at 1 o'clock here. So yeah, so reach out to me, Anne.Shadle at uky.edu. Yeah, I appreciate all of you being here today, and I hope to hear from lots of you. Don't hesitate to send me an email. Just jump right on there on my calendar, and we can dive into stuff, and I can help you guys get going. So it's it becomes, it's a process. It takes several months to go through it, but I'm there with you. Dave and Rhonda, the other coaches, we're there with you to help walk alongside you and make sure that you're, know what's coming next, and can kind of help anticipate what the next step is going to be. And, I kind of play middleman for my clients. So I'll talk to the bankers on your behalf and say, hey, this is the deal. Do you think you'd be interested? And what else do you need from us? And, all that stuff. So yeah, I'm glad you all have appreciated this. Thank you so much for your nice comments. Thank you for joining us today. And so like I said, survey I think pops up after this is over. And if you all can take that, I would appreciate it. And then just join us, stay hooked into what we do. Every Wednesday we do something, and then most Tuesdays or every other Tuesday we do some stuff as well. So got all kinds of all kinds of good stuff to keep on your radar. So I appreciate you all joining us today, and happy Tuesday.